Welcome to Rogue Trader. Please read the disclaimer and remember that prices can go down as well as up. Hello, and today's going to be a stock analysis update for Tekmar Group PLC. Tekmar's share price dropped 30% today, and this was because of a news announcement where they said they're going to try and sell the company. I did a video on Tekmar about a year ago, and so this stock analysis update will be updating you on that, plus what we've learnt from today's announcements. So Tekmar sell undersea cable and pipe protection systems, plus all the supporting engineering services around that. You can see here from one of their annual reports all these various items they use for the protection of electrical cables, and they particularly sell themselves as being part of the renewables sector, particularly their TechLink cable protectors. You have the wind turbines here, and their TechLink product, which they now call the Generation 10 cable protection system. It covers the difficult part between the actual support of the wind turbine itself and the seabed floor. They also provide cable protection for oil and gas pipes. We see that the offshore wind provides 57% of their income, with the subsea, which is more the oil and gas stuff, about 43%. And here I've got the same pie chart but 2020. We can see that actually the offshore wind part is now actually reducing in there as a percentage of overall revenues. And within the subsea, they had their main subsea innovation segment, but then there's also the Pipe Shield International and Agile Tech Engineering, and these are businesses that they acquired in 2019, but these are now all grouped together as the subsea division. So Tekmar IPO'd in 2018, and there was a rather curious story. This guy here, the company had actually been originally founded by his father about 30 years previously, who'd built up the company from nothing. And then in 2018, this guy, James Ritchie, bought the company off his father and did an IPO. However, 2 years later, he then went riding off into the sunset, and it's been interesting to see the company go to the dogs after that. Before he left, there was this very upbeat trading update. During his short time there, he saw them buying this Pipe Shield International, and actually when I look at the sales, they have got back quite a lot more in revenues than they paid for the business. However, since 2019, we've seen the cost of sales and operating expenses jump up. So it's hard to know if that was a good deal or not. And the chairman was then given the job of CEO, and all of a sudden this amazing trading update was followed after James left with a trading update that actually the company was starting to struggle a bit. I cover that a lot in my first video. Essentially the finances of the company were beginning to look quite strained, and as I described in my video, they were now running on gas in terms of the cash available in the coffers. My last video, the CFO left quite quickly after that. So you've got the CEO leaving and then the CFO leaving. So, it's starting to not look very good. And then in the full year results, we saw some really nasty numbers, a net loss of 6 million and operating profit of -5 million. So with all these things going on, the company is really looking on shaky ground. And I was already planning to do this update video, and I had most of my stuff here prepared yesterday, and I'd gone through their most recent sales announcements, and it looked like, actually particularly in the oil and gas area, they had some big new deals, but perhaps not quite enough to get them back up to this 40 million number they were in back in 2020. And there was just kind of too few announcements. So since January, there's been one announcement with no mention of how much. So quite a long time with no new sales announced. In the first quarter of this year, they actually did a equity raise and managed to raise 4 million. And they did an open offer which raised 150,000, and that was aimed mostly at retail. And you've got to feel sorry for those guys who already had positions and then participated in this open offer. But really 4 million isn't a very big number, and based on what the CEO had said in the 21 final report, in the 21 full year, The CEO predicted revenues of this year of about 32 million. And so based on that, I did like a rough guesstimate of them getting in around a loss actually of 3 million. And that was my kind of worst case rough guesstimate. Well, today they just released their interims. And sadly, although we know that they tend to get the greater majority of their revenues in the second half of the year, their interims were still a operating loss of 3 million. And when I look at the cash situation, they are still running on gas. And that's actually despite raising 4 million, they've still only got 5 million in the bank. Now, even yesterday, I was topping up the order book and sales predictions, and it looked to me like, yes, they could be breaking even, but you're just relying on big deals that I've not got vision of. And so today's announcement, where they're commencing with a formal sale process, this really confirms the situation that they really are in a situation where, without any massive new orders coming in, they're going to find themselves unable to pay the bills without future capital raises. And judging by how much they rose last time, they might not be able to achieve those capital raises again. So they've hoisted up the for sale flag, and they're going to try and sell the company to the highest bidder. In the interims, they say, whilst the group is currently operating with sufficient working capital for its requirements, the combination of sustained trading losses and increased pressure on working capital mean that the group may not have the necessary cash to make all the required investment to deliver fully the turnaround strategy to return the group to profitable cash generation within the timescale targeted by the board. In light of these matters, the board considers that the group's best interest will be served by seeking a strategic partner to support its opportunities for growth and provide additional balance sheet strength. So looking at the profit and loss, and I've actually summarized most of this already, but the general picture is that their revenues have dropped from where they were in 2020, and they're now loss making. This here is my own 2022 rough guesstimate based on information I have. This here is the actual numbers from the interims. But even as per the interims, they're losing money. One interesting thing is 2018 was before the IPO, and we can see that actually they had these horrible finance costs because the company was in debt before the IPO. And the IPO was successful in clearing those debts, so they no longer had to pay those, which then brought them into profit. You can see they were losing money, they IPO'd, and then they were nicely into profit. The unfortunate thing is that 2 years later, somehow that nice profit has just turned into a loss-making situation. As we can see here in the net income history, pre-IPO, a glancing moment of being profitable post the IPO, but then now in a terrible situation of losing money with the expenditure higher than the income. Now I've got here the sales by the different divisions, which are broken down into quarterly. And what's interesting here is that actually the Pipe Shield International business is actually looking quite bright, and I believe that this was where they had that 10 million deal in January. But the Tekmar Energy, which is now the offshore wind segment, and that's had the subsea and agile tech has been grouped into that even. So this red line here from 2021, it includes these other sectors, and yet even then it's dropping like a stone to the bottom of the ocean. And so this here actually is very useful information. So if I've got that correct, it looks to me that although actually there are increased revenues in the oil and gas related stuff, it looks like actually their main thing, which was their TechLink product, which I believe now is also called the Generation 10 cable protection system, that, which is what you see all the hype about, is actually the revenues are dropping like a stone. It looks like this might actually be the root of the problem, is in terms of their revenues, is frankly No one's buying their TechLink stuff anymore. And I could guess that could be because of competition. That at least is how I interpret that. And when I look at the sales pipeline, now the tender pipeline, that's stuff out there for them to bid for. The order book is then stuff which they're about to start working on, with the sales work in progress and completed, that they're then recognizing the money for. And we see that although the stuff for them to bid for is still rather high, the sales are actually dropped. This is only the first 6 months of 2022. It will be interesting to see what happens with the Dogger Bank deal, and we'll see obviously 10 million coming in, I guess, later half of this year for this Middle East deal. So I expect those sales to jot up again when we get to full year. But the problem is, we've got to achieve 50 million here, even for the really bad results we had in 2021. Yeah, so it really doesn't look good. And for me, I think it's all down to the stuff related to the cable protection systems for the wind turbines. And my guess, and it's only a guess, is that that's because of perhaps there's competition from other people, which is beating them to it there. So looking at the assets and debts, and we see here they had long-term debt before the IPO, and that got cleared by the IPO. And then that shifted the company into being in a net asset position. For 2021, we see the trade receivables about 18 million and the accounts payables at around 9 million. So, they're getting more coming in than going out, but it's still a bit tight probably, because they've got to cover the work that they're doing. They've got to cover stuff they're making now. So I said they were running on gas in my last video, and that was definitely still the case with only 3 million in cash in 2021. Now that number, despite a 4 million capital raise, is still only 5 million. Now it's actually 10 million as per their interims, but in that interims they say that their available cash at period end of 10 million overstates the group's available cash position, as it includes an overpayment of 5.2 million by a customer that has subsequently been repaid. Available cash at the period end, net of this overpayment, was 5.1 million. Actual cash for their 2022 interims is 5 million, and so they still are running on empty. It has to be said, how does that mistake happen? How does somebody accidentally pay you 4 million more? They've got this 3 million of short-term debt, which is a SSE.L loan. So that's actually part of the government's COVID scheme, where they were giving away all kinds of handouts and loans and stuff to companies. They are going to have to pay that back sooner or later. Looking at the statement of cash flows, they had 4.5 million coming in from working capital changes. Now, normally you want to see cash coming in from operating activities. However, in their case, they had a 1.5 million loss from operating activities. And this 4.5 million, it's from a decrease in trade receivables and an increase in accounts payables. And for me, that's a very weak positive cash flow. As a non-professional, that's a weak positive cash flow. In the world of accounting, those things are actually positive cash flows. And then the other 3.7 million of positive cash flow they had was from their capital raise. So again, that's kind of a weak positive cash flow, because it was from raising the money on the markets and the dilution of their current shareholders. Their other negatives were 0.6 million of capex and intangibles, which is kind of stuff they always have to do, and 500,000 of paying off debt. And of course, we know coming soon, when they have to pay off those COVID loans, that's going to be a 3 million of paying off debt. So the statement of cash flows looks very unhealthy. And then we've also got to remember that that included 5 million being paid by mistake by one customer. So when we take that away, this sort of unhealthy actual 7 million plus would be only a 2 million positive cash flow, of which 3.7 million was from a capital raise. So overall, it looks unhealthy to me. In terms of raw data, their valuation profile actually looks good because their market cap here is well below their net assets. The price to book is less than 0.5. I think though that the reason why their price to book is less than 0.5 is because there's some concern of some investors that they could be going to hell in a handcart. So for me, the most kind of interesting things about Tekmar now is that they were debt laden before the IPO and losing money. And then when they IPO'd, that actually cleared all their debts. But then after they bought this Pipe Shield International, the cost of sale and operating expenses seemed to jump up. And by 2021, the company's loss making. It seems that around this time, they stopped being able to sell their windmill related products. And so then this has left a kind of rather embattled company into one that's running out of cash very fast, despite the Pipe Shield International actually doing a lot better recently, including a 10 million deal only this January. So my verdict has to be to remove from the watch list. The main reason being there's just too many warning signs. They've just put the company up for fire sale. The founder's son IPO'd the company and then left after just 2 years. It's financially just still running on gas. The Dogger Bank and Middle East deals, which are some of the biggest deals they've ever achieved, give you this hope that they're going to move into profitability, but there just isn't enough visibility that they're going to get up to the 40 million number they need to, despite that. So you're just kind of hanging on in the hope. And another warning sign is they were only able to raise 4 million in their firm placing. My own personal suspicion is it really is that there must be competition in, which means they can't sell their tech link related products anymore like they were. And for me, this is the problem. Despite how they tried to make up with that with their Pipe Shield International business. But yeah, I actually feel kind of bad for this company and bad for the shareholders. But I guess what it comes down to maybe is they're in a kind of a bit of a niche market, and in these niche markets, you could be quite vulnerable to competition. I've certainly learnt a few things from studying them, and I hope this was useful to as many people as possible. So have a good day and good luck with your own investments. If you enjoyed this video and would like to support me, I'm on Patreon. There's a link to my Patreon page in the video description below.